first trillion-dollar company didn't win through innovation or fairness, but through financial engineering, monopoly pricing, and controlled scarcity. The Dutch East India Company, the VOC, turned spices into financial weapons. By mastering capital markets, risk pooling, cost control, and monopoly power, it created profits so extreme they reshaped global finance forever. Understanding how the VOC built, defended, and monetized its spice monopoly reveals timeless financial lessons about power, markets, and the thin line between efficiency and exploitation. The VOC's dominance began not with ships or spices, but with capital structure. In 1602, the Dutch Republic approved a revolutionary financial model, a permanent joint stock company. Unlike earlier trading ventures that dissolved after each voyage, the VOC allowed investors to buy shares that could be traded freely while the company retained capital indefinitely. This innovation solved a critical financial problem of long-distance trade, extreme risk combined with massive upfront costs. Ships, crews, weapons, and inventory required enormous funding long before any revenue appeared. By pooling capital from thousands of investors, the VOC diversified risk across society rather than concentrating it on a few merchants. This structure introduced liquidity through secondary markets, enabling investors to exit without forcing liquidation of assets. That liquidity reduced the risk premium demanded by investors, lowering the company's effective cost of capital. In modern terms, the VOC optimized its weighted average cost of capital centuries before the concept existed. Lower capital costs meant the company could outspend rivals, absorb losses, and survive volatile price cycles that bankrupted competitors. Financial endurance became a strategic weapon. Risk management was further strengthened through scale. The VOC spread voyages across regions, seasons, and products, smoothing revenue streams and stabilizing cash flow. Losses from storms, piracy, or spoilage were statistically offset by successful shipments elsewhere. This portfolio approach transformed unpredictable trade into a manageable financial system. Smaller competitors, operating single voyages with borrowed money, faced catastrophic failure from one bad outcome. The VOC faced variance, not extinction. State backing added another layer of financial advantage. The Dutch government granted the VOC monopoly rights, military authority, and legal protection. These privileges reduced political risk and external competition, effectively increasing expected returns without increasing operational costs. Government support functioned like a subsidy, but one paid in power rather than cash. Investors understood this, bidding up shares and reinforcing the company's capital strength. However, capital abundance introduced its own challenges. Large organizations face inefficiency, agency problems, and corruption. The VOC responded with standardized accounting, centralized reporting, and strict dividend policies. Regular financial disclosures increased investor confidence and maintained access to capital markets. Dividends were not only profit distribution tools but credibility signals, proving that monopoly power translated into real returns. The key financial lesson of the VOC's early success is clear: control over capital determines control over markets. By lowering risk, increasing liquidity, and aligning investor incentives, the VOC built a financial engine powerful enough to dominate global trade. Modern corporations, hedge funds, and even governments still rely on these same principles. The difference is scale and speed, not strategy. The VOC proved that financial architecture, when designed correctly, can outperform innovation, labor, and even morality in the race for profits. With capital secured, the VOC focused on extracting maximum profit through monopoly economics. The core principle was simple: control supply to control price. By eliminating competitors and limiting production, the VOC engineered artificial scarcity in European spice markets. This allowed prices to remain high regardless of production costs. Financially, this shifted the business from volume-driven margins to price-driven margins, dramatically increasing return on invested capital. The VOC practiced vertical integration to defend this pricing power. It controlled production zones, transportation, storage, and distribution. Each layer removed external markups and reduced transaction costs. Cost predictability improved budgeting accuracy, and stabilized profit forecasts. More importantly, integration prevented competitors from accessing supply chains, reinforcing monopoly status. Financial barriers replaced military ones as the primary defense mechanism. Cost control was relentless. The VOC standardized ship designs, crew wages, and procurement contracts. Bulk purchasing lowered unit costs, while centralized planning reduced duplication. Even minor efficiencies compounded across global operations. When revenues are fixed by monopoly pricing, every cost reduction flows directly into profit. This created extraordinarily high operating margins by historical standards. However, monopoly economics introduces demand elasticity risks. Excessively high prices can suppress consumption or encourage substitutes. The VOC managed this by balancing scarcity with market tolerance. Prices were raised gradually and unevenly across regions, maximizing revenue without collapsing demand. This was early price discrimination, extracting consumer surplus while maintaining long-term profitability. Another challenge was capital lock-in. Spices required long storage periods to time market releases. Inventory carried opportunity costs and spoilage risks. The VOC mitigated this by treating inventory as a financial asset rather than dead stock. Controlled release schedules smoothed revenue streams and reduced price volatility. In modern terms, inventory management functioned as a revenue stabilization tool, not merely logistics. Ethical costs were ignored but financial risks were monitored carefully. Rebellions, enforcement expenses, and corruption increased operating costs over time. The VOC responded by increasing extraction rather than reform, a short-term financial solution that weakened long-term sustainability. Monopoly profits masked declining efficiency, a classic case of financial success hiding structural decay. The financial takeaway from the VOC's monopoly phase is stark. Monopoly power maximizes profits not by innovation, but by controlling access, suppressing competition, and managing perception of scarcity. Yet these gains are fragile. When costs of enforcement rise faster than revenues, monopoly economics collapses under its own weight. The VOC's system worked for decades because capital reserves absorbed inefficiencies. Eventually, even the largest financial cushion proved insufficient. For modern finance, the lesson is cautionary. Pricing power is the most valuable asset a firm can possess, but it must be paired with cost discipline, demand awareness, and long-term reinvestment. Otherwise, monopoly becomes extraction without sustainability. The VOC mastered profit extraction, but underestimated the financial consequences of ignoring resilience. The VOC proves that finance is not neutral, it amplifies intent. Capital structure, risk management, monopoly pricing, and cost control can create unimaginable wealth, but they also magnify weaknesses when misused. True financial strength is not measured by short-term dominance, but by sustainable value creation. The ultimate lesson is this: money obeys systems, and systems reward discipline. Master finance responsibly, or it will eventually master you.